Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical driving markets at the moment. Whilst I just let you have a look at the disclaimer, I just want to point out, first of all, actually, that I have we have a technical issue actually with our charts at the moment. So for this webinar, at least we won't be able to go through some of the charts, but we do still have lots of graphics and other charts, if you like, non-price charts to show you and really to look at in this packed week, which is coming up. Yes, I'll just run through what we hope to get through in the next 30, 40 minutes or so. We will look at this idea around the shipping rates, which are going up, global shipping rates, freight rates, due to the events in the Middle East and the Red Sea, and potentially then that being a theme because it's impacting going forward on inflation rates, certainly in the headline and possibly in the core in due course. We'll look at that. We'll look at Q4 earnings as well. Before then, a quick review of UK's data last week. So that was the inflation data and the wage data, really important for the Bank of England. That before then, getting on to the main events for this week, which include the ECB. We'll look at that. And what's expected there, as well as the BOJ. There's a meeting there. The Bank of Canada is a meeting on Wednesday. Plus, then we'll look at a load of US data out this week, including GDP and the core PCE deflator, which is the Fed's favored inflation gauge. So a lot to look forward to, of course. Firstly, we'll just touch on this global rise in shipping costs. Concerns here that, as I say, it does or will impact inflation rates going forward. They are surging across multiple global measures, ranging from a global composite to regional variations. This chart actually from Bloomberg shows the Drewry World Container Index. That's one measure, really. It's soared around, 175% since November. And of course, its rise, I think I had a chart last week, actually pales sort of in comparison to what happened during the pandemic, of course, but that's still a meaningful rise, of course. And of course, if we think about the pandemic, that was the biggest sort of history-busting disruption to supply chains ever witnessed during peacetime. So if you take that out of the equation, it's still a big rise, and potentially then you can see this correlation with US CPI, the blue line US CPI there, and potentially then we get a pickup in these freight rates, in these shipping rates, and then a pickup in US CPI. That is something to be mindful of going forward, certainly with this, with these events, of course, in the Red Sea. Otherwise, just checking out markets actually at the moment, equity futures are trading higher, really extending gains that saw the S&P 500, of course, last week record a record high on Friday. Stocks in Asia, actually more mixed. The Nikkei recording another strong gain ahead of the Bank of Japan meeting, of course, tomorrow. Whilst Chinese and Hong Kong stocks continue lower on pessimism really around the economic outlook. And we'll actually just touch upon some of the China data out of last week, really, which we'll be seeing these falling stock markets, of course, in Hong Kong and China, but exacerbated again by that that really disappointing data from last week. The dollar pretty flat today to start this week. It pushed lower actually on Friday as risk sentiment rose after, well, we did have the University of Michigan survey that showed a mix of basically high consumer confidence and lower inflation expectations. Other markets at the moment, crude oil that trades marginally higher. No Middle East escalation seen over the weekend, at least. And as Libya is due to restart production from a major oil field, markets really in oil markets anyway will alternate probably their focus between the risk of a disruption, of course, and then soft demand, with an IEA forecast pointing to a well-supplied market in 2024 this year. Gold, that remains, well, slightly in the red. Traders really adjusting positions to reflect this potential pushback, this delay in the timing of the first US rate cut. We do get, of course, more earnings this week. 76 S&P 500 listed companies releasing this week. I think around 16% of all those companies. Then full-year earnings this week. As the earnings season really broadens out, and this chart just shows you growth is expected in most of the sectors. You can see utilities projecting the highest year-on-year growth, energy, materials, the laggards really. Key names this week to look out for will be Tesla, of course, Netflix, Intel, Visa, Amex, and GE amongst those 76 S&P 500 listed companies, as I've said. So far, with only about 10% of reporting companies actually already done, the season kind of somewhat of a disappointment, especially on the revenues front. But these are the expectations across the earnings season this time around. Regarding Tesla, no doubt grabbed the headlines. Of course, its shares really have struggled this year compared to, of course, the other tech giants, probably more directly involved in AI. The shares have lost 20% actually of their value just in the last 14 days. That's Tesla. Competition from rival electric vehicle makers, especially in China, that's a headwind. BYD recently overtook Tesla actually in vehicles sold in the final quarter of last year. And really major support will be, well, sits around $200 on the Tesla chart. And that is also the midpoint of last year's rally. So interesting. We're trading just above that at the moment, at $200, the $200 mark. But interesting whether any disappointment, then we test that level. 212.19 was the close on Friday in Tesla. For Netflix, that comes on the back of a near 40% rally, actually, from just before its last earnings release in late October. Price is now tracking just below $500 at $482.95. That is still some way off its all-time high, around $700 from November 2021. As for the major indices, the tech-heavy NASDAQ and the S&P, they both hit record highs on Friday. The NASDAQ 100, that surged nearly 2% actually Friday, hitting 17,314. The broader benchmark S&P, that gained 1.23%, I think, to hit 4840. Again, also an all-time closing level high. Semiconductors really the fuel, the catalyst for this move higher in those two indices. The semiconductor index actually surged 4%, gains led by, of course, Nvidia, AMD, Broadcom, Qualcomm, all rising over 4%. That came really on the back of this upbeat outlook that we got from TSMC. So that's the Taiwan-based global chip manufacturer. That reported last week and propelled sentiment really of the whole semiconductor space. Interesting then, we're getting this sort of bullish momentum into the upcoming mega cap earnings, which do come next Thursday, February the 1st, a sort of super Thursday really. I think we get Google, Amazon, Apple, and Meta all next Thursday. And that is actually the day after the Fed meeting as well. A big 48 hours really for markets then. But yes, we have seen this bullish momentum coming into the next week really. And then potentially, of course, questions around this March rate cut by the Fed. We'll look at that shortly, but just below 50% now for the bets on a March rate cut. And if that does change and go back again above 50% towards 60, 70%, then potentially that underpins strength, of course, for this push higher in equity markets. I think generally, though, markets are overbought on both the daily and really the weekly RSI now in both the S&P and the Nasdaq. The weekly is just below overbought territory, actually. The weekly RSI, that is around 68, but it is a sort of positive breakout after consolidation just below the highs. And on the daily as well, prices just below actually that overbought territory, but getting close to it. And we did close on Friday near the highs of the day in the S&P at least, and also the Nasdaq. Nasdaq slightly more overbought, 71.96 the daily RSI, and the weekly just above 70 as well on the weekly RSI, that is for the Nasdaq. The Dow as well didn't quite break out as strongly, but still up over 1% on Friday, tracking sideways on the week and on the daily, and just pushed up towards the close of 37,863 eventually on Friday. Of course, we had that 9-week bull run as well in the S&P, and that was last seen in 2004. So that's that pulled just shy of the all-time high, of course, late last year. It's interesting, the enthusiasm that drove the rally of this basically 16%, 16% gain was in the last 2 months of last year. That sort of enthusiasm slightly ebbed, even though we have had that breakout higher. And it's really not surprising, because that 16% gain, almost 60% gain, that performance puts it in the 99th percentile of returns over comparable periods. So not surprising, probably enthusiasm has waned slightly, although technically, of course, the indices have been pushed higher, predominantly by those semiconductor stocks and tech in general. So, of course, still slight worries about, again, the breadth of the market. But it isn't as bad as it has been, because it obviously did improve, and we've talked about that a lot over the last few months. Just on that momentum, then the S&P actually has taken 3 weeks to add 1.5%. This next 1.5%, if you like, to get to those all-time highs, and really down to that recent data pricing in or reining in those rate cut bets. If we just go to last week's main data, just quickly, we'll look at the UK mid-month data dump, really is what we call it. So normally all around the middle of the month, we do get a burst of UK data, including, of course, wage data, employment data, CPI, and retail sales. The labour data and wage data cooled more than expected, so that was encouraging. Private sector regular pay growth, that removes the volatile bonus category, that sits at 6.6%, so down from 7.2% in October, and a peak of over 8% last summer. Employment or unemployment was steady, 4.2%, though there are still processing issues really with that. And there was a small increase in jobless claims, but it really was slowing wages and some easing in this labour market tightness, which was encouraging for markets, and potentially will then dampen broader price pressures going forward. That said, of course, we then, the following day, last Wednesday, had above expected UK inflation. You can see that on this graphic. The headline, well, the month-on-month came in 0.4, that's double the market consensus, and then the annual rose 4%, so up from 3.9% in November, and versus the 3.8% expected. The core rate as well, that didn't move below 5%, so 5.1%, so 0.2 above the estimates, and that was actually the first month since July that the core hasn't actually fallen. Services inflation as well, always talk about this, which is key for policymakers, that actually increased to 6.4% from 6.3%, although it is actually still below, somewhat way below, actually 0.5 below the Bank of England's recent forecast for services inflation, which was 6.9%. So a hotter than expected report generally, and that did, reignite really the idea around sticky inflation in the UK, and then that saw really expectations for Bank of England easing get pushed back, of course. now around 105 basis points of cuts priced in for 2024 this year, and roughly around just above a 50% chance of a first cut in May. Did see a big reaction with those expectations of easings getting pushed out, as I say. Also, the FTSE 100, the equity index, that's sold off 1.5%, with sectors like the interest rate sensitive real estate sector really selling off 3.5%. So going forward, Bank of England officials, they have already signaled that the January data, the inflation data, may be high, may be beefed up by higher energy bills. But then after that, most economists really do expect quite a sharp fall in inflation in the UK, and potentially by the summer we do get sub 2% inflation prints, really down to those energy bills actually coming much lower after April, or in April and going after that. You can see the chart here, 4% and 5.1%, as we just shown you from the graphic. So just a stalling in this disinflation process that we have seen, and still way above that 2% target, which we've obviously put in here. I did say I'd mention, well, first of all, before going into China, we're just, I can't show you a chart at the moment, apologies for that, but just on cable, so that's sterling against the dollar. We're just tracking sideways really over the last probably month or so now. 126, 128, 28 is sort of the range. We're pretty much in the middle of that, slightly picking up this morning. 127.23 now currently in cable. We've got the 50-day moving average at 126.28. So that may offer support just above that sort of range low, if you like, around 126 or so. So we're stuck sideways, waiting for catalyst really. And potentially, well, interestingly, yeah, we sort of sideways trading with a bid after the CPI data, but then obviously that wage data the day before just sort of eased, just sort of saw some selling on the Tuesday before then that bid on the Wednesday, and we just sort of picked up towards, well, just back to where the sell-off began actually after the wage data on Tuesday. So we're, yeah, 127.24, and that range still holds. 126 up to sort of 128.28 was the high from late December. Chinese data, I just said I'd mentioned because it was bad and it did grab the market's attention. GDP was a sort of headline grabbing number, and that's, I think, growth stood at 5.2% for last year, so beating, unsurprisingly, the government's 5% growth target. But it was really around all the other data we got actually out of last week. So retail sales, that missed expectations, and then home sales really got some grabbed the headlines really, because home sales, they dropped to a new low in December, 50% below the pre-pandemic level. And then house prices, they fell 0.5% month on month, and that marked the biggest drop since 2015. So the numbers really raise warning still around the housing crisis continuing to deepen, and also that the consumer engine is as well slowing down. All kind of highlights the need potentially for further stimulus, although whether we do get that from the authorities, who've not sort of given us that much of a heads up really, and guidance around that is interesting. Chinese offshore stocks, of course, they've taken a big hit, as we said already, and they're down to the sort of the lowest level since November 2022 now. As I say, calls for additional fiscal stimulus are growing, will grow. The government is rumoured to set a growth target between 4.5–5% for this year at the March National People Convention, and calls really around stimulus will certainly grow larger, you would think. Just looking at dollar CNH, we pointed that out last week actually in the sort of resistance around 720 or so. We did break that sharply with the disappointing data last Tuesday. a strong breakout to the upside, and we got up towards 723.21 before we just paired those gains in the dollar against the CNH, and we're just sort of back to around the 720 level. So that should potentially offer support. We do have the 200-day moving average at just below there at 718 as well. That has just crossed actually. Oh, sorry, the 50-day moving average just crossed now below the 200-day moving average. So a death cross possibly in play, but 720 initial support in dollar CNH. Okay, let's get to the main event for this week, which is well, the central bank meetings, but certainly the ECB meeting for us. Expectations for policymakers to stand pat, of course, on all three key rates, having held the deposit rate at 4% since October. That was, of course, the current peak. In terms of the economy, well, headline CPI, that rose to 2.9% in December from actually previous 2.4%, due essentially to unfavorable energy base effects from Germany. It is expected to be temporary, that uptick, and the disinflation process is probably will still remain in place. The core, certainly that decline continued, December showing a downtick from 3.6% to 3.4%. On the growth front, well, Q4 GDP actually is not released till next week, the 30th, but we did get a German full year 2023 GDP release, which was preliminary negative 0.3% quarter on quarter. And then for the PMIs, well, they held steady actually at 47.6, while the services ticked higher to 48.8, and manufacturing nudged up to 44.4 from 44.2, but still well below, obviously, any kind of contraction area above 50. Looking at it all, and despite the slowing trend really in the inflation and subdued growth, probably January too soon for the ECB to commence its rate cutting cycle. Policymakers certainly over the last few weeks have been attempting to dampen any market expectations for an aggressive path of reductions over the past few weeks. As we said, President Lagarde, she was out at Davos last week actually, and she really probably set the tone for what to expect on Thursday. She said about market pricing for rate cuts, it is not helping our fight against inflation if the anticipation is such that they are way too high compared with what's likely to happen. So really an emphasis should be on the way too high expectations for near-term easing. And actually then when asked directly about a summertime cut, actually relative to earlier pricing, she said, I would say that's likely. But then she did stress that the bank is still certainly data dependent. It's probably what we get then this Thursday, a signal. And we also got a fair amount of pushback, actually concerted sort of synchronized pushback by quite a few ECB officials last week as well at Davos. And that's probably what we will get most likely on Thursday. Market pricing then, yes, around definitely we've seen this dovish repricing change. Markets now expect, well, around 128 basis points, I think, from previously above 160 basis points of cuts. That is this year, 160 basis points of cuts. That was sort of priced in just after the ECB's December meeting, now down to sort of 128 basis points of cuts or so, and around a 66% chance of an April move. Of course, at the peak of the rate cut cycle, if you like, there were quite a high chance of a March cut. Economists, for what it's worth, they're slightly less hawkish leaning, median seeing a rate cut around June and then a total of around 100 basis points of cuts this year. So they're more hawkish, if you like, and still think the market is pricing in too much or too many rate cuts. We do get other important data as well. Certainly the flash PMIs on Wednesday will be important for January. And also, actually, tomorrow we get the ECB Bank Lending Survey. Both those data sets weighed quite heavily on the euro last autumn, winter, so will be closely watched by markets. And again, the composite PMI is a reliable indicator of overall economic performance. And as we sort of briefly mentioned, is sounding the recession alarm for the Eurozone, because it's still tracking, as I said, well below 50, even though potentially there might be a slight improvement in January. Also important will be tensions in the Middle East, certainly with this disrupting of shipping lanes and delivery times in the PMIs. They may offer early clues on the scale of the problem. Delivery times, just to let you sort of know, really a good leading indicator for goods price inflation. And again, potentially that feeds in to inflation, keeping it stickier than we're currently expecting. That is the ECB then. Will be about President Lagarde's tone and language in the press conference, but we think, as we've pointed out quite in detail there, that she should just say what she had said, of course, last week. As for euro dollar, that's being supported by the 200-day moving average at 108.45. Tapped that level a couple of times last week and bounced quite nicely off it. We're now just below 109, and we have a resistance just above at the 50-day moving average at 109.21, and then also just above that at 109.31 is the halfway point of the December rally. That's at 109.31, as I said, and then above that, next fib level will be 109.80. So that's euro dollar. Next up, we have the Bank of Japan meeting. Not much expected here. Again, they will release the latest outlook report, which contains basically board members' median forecasts for real GDP and core CPI. Certainly, there's the usual caution around the Bank of Japan because they do seem sometimes to enjoy surprising markets, but there's probably little reason now at this point to expect Governor Ueda to indicate really a desire towards ending negative rates or tweaking yield curve control at this meeting. Core inflation, that has weakened compared to the acceleration that was unfolding over the second half of 2022 into early 2023. Sorry, I've just got the Eurozone inflation charts there that you can see. I'll just move on to the Bank of Japan, and you can just see, yes, as I mentioned, core inflation has weakened compared to that acceleration we saw at the back end there of 2022 coming into 2023. It may well be that the effects of prior increases in oil prices and prior then yen depreciation work through the CPI basket as temporary effects, leaving really soft underlying pressures in their wake. And you kind of think if Ueda didn't have the confidence to lift off and out of negative rates when core inflation was higher, then of course he probably won't be doing it now. As a reminder, the Bank of Japan disappointed those outside bets that there would be some policy tweak in December. And really reiterated dovish forward guidance and the pledge that it will not hesitate to take additional easing measures if necessary. Probably the next step or the next test for the Bank of Japan will be the spring wage negotiations. We've mentioned that numerous occasions, and whether really they turn in the strongest back-to-back wage increases in decades. That will be key, and probably that's why it may be quite a relatively quiet meeting for the Bank of Japan. Certainly those statements, the outlook report might be interesting, clues around future policy, and if there's any adjustment to members' projections with, well, there was meant to be a lower projection for CPI, but then sources have stated that they will probably maintain the projections, which sees trend inflation will stay near 2% in the coming years. And core will hit 1.9% in 2024 and 2025. Of course, you also have to bear in mind expectations for a rate cut this year by other key central banks does probably effectively lessen the pressure for the Bank of Japan to normalize policy. Although many economists, let's not forget, still do expect the Bank of Japan to exit negative interest rate policies around April, when the next forecasts are, and then potentially scrapping up then. Although, as we say, you have to bear in mind all other central banks really not pressurizing then the Bank of Japan to move. Dollar yen, just checking out where that is, currently just below 148. We've had this big jump around, well, as much as 5.6%. The yen has tumbled this month alone as it's pushed up dollar yen up towards 148. The high from Friday was 148.80, and we just pulled back slightly from that with Treasury yields just going lower, actually below 4.1%, the 10-year US Treasury yield. Just checking out, initial support was probably at 147.45, and then, as I say, that recent high is at 148.80 in dollar yen. Otherwise, we have the Bank of Canada meeting, again, possibly potentially fairly quiet markets, and consensus seeing them not, the Bank of Canada not moving rates from the current 5%. We do get an MPR, monetary policy report, as well as fresh forecasts and the press conference and Q&A. Forward guidance is probably key. Probably Governor Macklem, as he said during his pre-holiday speech in December, well, underlying inflationary pressures are easing in much of the economy, but then we have had a tick up in well, we've had a tick up in the trimmed mean and the weighted median CPI over the past 2 months. So potentially then way above still the headline target of 2% over the medium term. And those gauges are used to assess whether the bank is on track to achieving that target, because they weed out some of the more volatile components in the headlines. So yeah, weighted 4.1%. In November, 4.7% in December, and the trim mean 3.6% in November, 4.8% in December. So probably then it would be a major surprise if Governor Macklem does sound more dovish. He'll probably be more cautious, if anything, and continue really to intimate the markets are probably overly aggressive in pricing near-term rate cuts. And that's what he did in his speech before the holiday period in December. He also said then actually that the bank will want to see clear evidence through volatile readings that they're durably on track to 2% before easing. So that's the Bank of Canada meeting. Dollar CAD sort of pushed up towards, well, up to 135.41 middle of last week, and just above the 200-day moving average and 50-day moving average, but then fell sharply on Friday with better risk sentiment, certainly helping the Canadian dollar, falling then back through the 200-day moving average. That's at 134.80. Back through actually a fib level, 134.53 of the October decline, that is. So that might offer some resistance to dollar CAD as we looked at the Bank of Canada meeting. Otherwise, we do get a fair amount of data, as I said, US data out this week. Q4 GDP, that's expected to show growth of 2%. So easing back from that blockbuster 4.9% in the third quarter. Analyst forecast ranging between 1.3% and 2.8%. Interesting, really, that consensus probably, well, they've underestimated momentum in the US economy for 6 consecutive quarters, potentially, as well as this one. And they forecasters come into each quarter over this period expecting either contractions or very soft growth, only then to spend the whole quarter revising up their forecasts. That's probably exemplified in the Atlanta Fed GDP Now estimate. That's tracking Q4 growth at 2.4%, so above that 2% analyst consensus. The estimate was actually revised up 0.2 from 2% after the better than expected retail sales we got last week, industrial production and import export price data as well. That noticeably large beat actually in retail control metric that feeds directly into consumer spending for the section in GDP. So potentially a better GDP figure than anticipated. The Fed's median dot plot actually currently expects real GDP to ease to 1.4% by the end of 2024 before picking back up slightly to 1.8% through 2025. So watch out for GDP, of course, and then we do get, as we said, the Fed's preferred inflation gauge, the price deflator for total consumer spending, and of course, excluding food and energy. After the CPI, that landed at 0.3% month on month in December for headline and core, and PCE expected to be a touch softer at 0.2% for both readings. Certainly, if the data is in line with expectations, the annual rate would fall to 2.9% from 3.2%. And as Nick Timiraos actually points out, the 3-month and 6-month annualized rates of core PCE inflation would then fall to 1.5% and 1.9% respectively. So that will be interesting. Potentially then for the dollar, well, we do get durable goods as well. They're released on Thursday, and then they're expected to post a decent gain on the back of higher aircraft orders, and we do get the weekly jobless claims. They've been interesting, very low. The latest week was back down towards post-pandemic lows, actually, of 182,000. I think that was set in September 2022. So, yeah, interesting, maybe volatile, really, if we get an above consensus for quarter GDP number. That could mean markets further pare back Fed easing expectations this year, but then potentially watch out for that core PCE number as well. If it's below sort of 0.3, 0.2, even 0.1, then that could then reverse some of those moves we see after possibly better than expected US GDP number. As for the dollar index, that's pushed higher, of course, since those lows at the end of December. 100.61 was the low there. We're now back above 103, although just off our highs from last Wednesday at 103.69. We're now again below the 200-day moving average, so that's a 103.46, but still above the 50-day moving average, so that's a 102.88. So a couple of levels for you on the US index chart. Okay, I'll wrap it up there. Hopefully that's proved of use to you guys. A lot going on this week, certainly. So expect some volatile price action and some trading opportunities for sure. Please do follow us on social media, and we will speak to you next week.